Hey, what's going on everyone, and welcome to episode number 26 of this educational video series. I'm your host VJ and I'm a CPA. Apologize for lack of videos over the past several weeks. As you may know, it was a busy season and just couldn't allocate as much time as I wanted to making and producing these videos. So apologize for that, but now that the busy season's over, should be able to produce regular videos going forward. Okay, today's video we're continuing to look at some of the most popular small business entities, how to form these entities and how they are taxed. If you recall, over the past couple of videos we saw how to form a sole proprietorship and how they're taxed, and we also saw how LLCs are formed and how they're taxed. In this video, we'll cover how the corporations are formed and how the corporations are taxed. So let's get started. Okay, so forming a corporation is a very document intensive process compared to the other two entity types that we discussed in previous videos. Forming a corporation is governed by the state's law, the states in which your business is going to be located in. So you might want to study the specifics of the states that you're going to be operating in, but this few steps are the basic steps that generally all states require. Now the very first step to form a corporation is that you have to choose a unique name. Now this name cannot be used by any other business in the state. So if the name you want is already taken, you may have to come up with a different name. Step 2 is to file the articles of incorporations. These are basic articles that you file with the state, and it generally lists the basic information about the company, the type of business, the location, etc. On these articles of incorporations, you also have to choose a registered agent. Now, registered agent is just a person or a business that the state can communicate with in case if they want to send any legal or other documentations, etc. Usually you as a business owner can be a registered agent, or your CPA or attorney can be a registered agent as well. Now again, this depends on the state your business is located in. Some states may have specific requirements as to who can or cannot be a registered agent, so you might want to do some homework before you choose the registered agent. But in general, it can be a CPA or an attorney or the business owner himself or herself. Now the articles of incorporation also includes the information about the incorporator. Now, incorporator is just the person that files the articles of incorporation. It can be the business owner or the initial board of director. It can also be the attorney or a CPA. Now, the third step in forming a corporation is to set up a corporate record book. Now, corporate record book is an essential part of forming a corporation. It will keep all your corporation related paperwork in order. Generally, this record book includes articles of incorporations, your corporation's bylaws, any minutes and other minutes of your first and ongoing shareholder or director meetings, your share certificates, etc. This corporate record book must be kept at the business's principal location, and it should include all legal paperwork related to forming and operating the corporation. Now, the next step in forming a corporation is to prepare the corporation's bylaws. Bylaws are internal corporation documents that establish the basic ground rules for operating your business. So it should have all the information about how many directors the company will have, who are going to be the officers of the business, how many when to hold the corporation's annual meeting, etc. So all it has all the information that will be needed to run the corporation day to day, or in case if there's any dispute among the shareholders going forward. So it's a very important document for your corporation. The next step is to appoint the initial corporate board of directors. Now, usually this step is done by the incorporator of the business. What an incorporator does is he or she files a document on the corporation's record book. The document is called the incorporator statement, and it lists initial board of directors until a meeting is held by the corporation's initial board of directors and shareholders choose the regular corporate directors. Again, this is also one of the essential steps in forming corporations, and this steps usually performed by the incorporator. Now the next step is to prepare the minutes of the first board meeting. This minutes usually dictates the discussion that happened during the first meeting of the first meeting of the initial board of directors. It should include the information about the tax year of the business, where the corporation chooses to open a bank account. It may also include the information about issuing the stock certificate, etc. So this is something that you have to keep on file as well. It may come handy in future should there be any dispute or anything. And the final step of this process is to issue the shares issue the certificate of stock. Now, when the first meeting of the initial board of directors held, in that meeting, it's decided who's gonna get how many shares, and the last step is just to issue those shares or certificate to the shareholders. So as you can see, this is a very document intensive process, and you have to keep a detailed record of all these steps or the documents on the corporation's record book. It may come handy going forward if there's any dispute among shareholders, or if if there's any legal requirement from courts or states or any other jurisdictions. So something to keep in mind, and it's not something you want to cut corners. One of the steps in this process that you can also do is obtain or apply and obtain the federal tax ID number. Just a simple process of simple application that you have to fill out with the IRS and get the FEIN. The corporation will not be able to open a bank account without the federal tax ID number, so it has to be done before you open a federal bank. Before you open the bank account. Okay, so once you follow all these steps, you have incorporated your business and created what's known as a standard corporation or a C corporation. Now, C corporations are usually not the most popular type of business structure among small businesses, but we'll cover anyways just to get a brief understanding of how they're taxed. C corporations are separate taxable entities, and they file their own tax return on IRS Form 1120, and on this tax form they pay the taxes on the corporate level on any taxable income they have. Any amount of distribution, any income that's distributed to the shareholder owners of the C corporation is treated as a dividend, and then the shareholders must also pay tax on the dividends that they receive. So thus the concept of double taxation, right? The corporation pays the tax and then distributes the profit to shareholders, and then shareholders pay tax on the profit they receive from the corporation. So as you can see, because of the double taxation, it's usually not the most popular business entity structures among small businesses. All the big corporations, like the Apples or Microsoft of the world, they are C corporation. but for small businesses, it's usually not the most cost-effective way to form or operate a business. So what happens is most small businesses, after they incorporate, they choose to be taxed as an S corporation, also known as the subchapter S corporation. In order to get the election for subchapter S corporation, after completing all the steps that we discussed on the second slide, the business owner or the corporation has to file a form 2553 with the IRS, and once the form 2553 is approved by the IRS, the business is now S corporation and will be taxed as an S corporation. Now, S corporations is one of the most popular business entity structures, but there are some limitations as to which businesses can choose to be an S corporation, such as if a business chooses to be an S corporation, it cannot have more than 100 shareholders. All shareholders must be individuals or certain trusts or estates, meaning LLCs or other corporations cannot own shares in an S corporations, or all shareholders must be resident alien of the United States, etc. So if a business meets all these requirements, then it can definitely choose to be taxed as an S corporations. Now let's take a look at the taxation of S corporation. S corporation, it's just like an LLC, is a pass-through entity, and it files an informational tax return with the IRS on Form 1120-S. So as the corporation itself will not be taxed, and all the income or loss is passed through the owners of the corporation, and then owners report the income or loss from the business on their personal tax return. So as you can see, just like an LLC, the owners or shareholders of the business pays their share of the tax on the income received from the business. Now what separates S corporation from the LLC is a reasonable compensation requirement. And what this requirement is that IRS requires the shareholders of an S corporation to take a reasonable compensation for the amount of time they allocate to run the business, and only the compensation received by the shareholders as part of the reasonable compensation requirement is subject to the self-employment tax. The remaining profit from the business can be distributed to shareholders as a tax-free distribution. If you recall, under the LLC, the entire amount of income received from the business was subject to the self-employment tax, and the owners of that LLC had to pay 15.3% self-employment tax on the business income. Under the S corporation requirement, only the reasonable compensation received by the shareholders from the business is subject to the self-employment tax. The remaining profit of the business that's allocated to the shareholders can be distributed as a tax-free distributions. This distinction alone from LLC to an S corp can save shareholder owners thousands of dollars in potential taxes. Now I'll cover an example in next video that'll show how a person making $100,000 in net income will be taxed under all three business entity structures: sole proprietorship, LLC, and S corporation. And we'll see how S corporation can save thousands of dollars to this person compared to the other two entity type. And this in fact is why S corporations are actually very popular business entity structures among small business owners compared to LLCs or sole proprietorships. So if you're operating an LLC, and if you meet the requirements of an S corporation, then you should definitely consider switching to an S corporation to save potential taxes, to save some money on potential taxes. So hope that makes sense to you all. If you have any questions, feel free to reach out to me. I'll be more than happy to answer any questions you may have. Or if you have any idea about the future video that you want me to create, also drop me a line. I'll be more than happy to incorporate that topic in my next video. Last thing before I sign off, like the video, please don't forget to hit the like button, share with your friends and colleagues, and subscribe to my YouTube channel. Hope you found this information useful. I'll see you all next time. Take care. Bye-bye.